All right, everybody. Ladies and gentlemen, hello and welcome to us here at Nadex. My name is Philip and I will be a presenter for today's webinar. Today it's about an introduction to binary options. We have a revised edition of that webinar coming up. So yeah, welcome very much and I'm glad you guys could make it and looking forward to giving you that presentation and to delivering you the content. If you have a look at your webinar interface, you can see once again that small questions box. And just as always, please don't be shy. If you do have any questions, that's what we're here for. Ask those questions, put those questions into that small box, and do my very best to answer those questions as we move through the webinar. And in order to mitigate some of that shyness, I would appreciate now a very short yes or why in that box so that you just get used to it, to just let me know that the audio and the screencast are working properly. Thank you very much, everybody. Really appreciate the feedback. Glad to see that those technicals have been sorted out and everything is working just as usual. This webinar is scheduled to run for around about half an hour. And of course, before we get started, there are our usual risk disclaimers, which I need to make you aware of. So please take a moment of your time to read through them carefully and make sure that you're okay with them. Essentially, this says that trading, of course, involves risk. And you should understand those risks and the instruments you're using before you're getting active in the market. Major part of this understanding the instruments is what we will do today. We want to understand binary options really inside out. Neither Trade with Position nor myself are investment advisors, and therefore nothing that we say should be considered to be actual investment advice. All examples are shown for educational purpose only, especially true for the live part of today's webinar. We will be looking at the markets together. I think silver did some very nice and interesting moves especially, but whenever I say it's a nice move, it's an interesting move. That's just my view. That's just my perspective. I will try to explain why I think that that's the case, but this is never a trade recommendation. In the end, you must have a strategy. You must own that trade. You, for yourself, must have come to the conclusion that this is the right trade to take. What I'm telling you guys here is just my perspective. And with trading, there is not this one size fits all. Trading can be done in so many different ways, and in the end, you have to find something that works for you. What I'm sharing here with you is just my approach to trading, and I can explain why it works for me and why I like to do what I do here. But in the end, you must be 100% sure that that's your style of trading, and you must own that trade. So it's never a recommendation coming from me. It's always just educational content. Please make sure you're okay with that. And to follow up, we also have the Nadex risk warning coming up. Trading on Nadex involves financial risk and may not be appropriate for all investors. The information presented here is for information and educational purposes only and should not be considered an offer or solicitation to buy or sell any financial instrument on Nadex or elsewhere. Any trading decisions that you make are solely your responsibility. Past performance is not necessarily indicative of future results. Nadex contracts are based on underlying asset classes, including forex, stock index futures, commodity futures, cryptocurrencies, and economic events. Trading can be volatile, and investors risk losing their investment on any given transaction. However, the design of Nadex contracts ensures investors cannot lose more than the cost to enter the transaction. Nadex is subject to US regulatory oversight by the CFTC, and that risk limiting part, which allows us to do really precise risk management, position sizing, is a major bonus and factor and a major advantage for trading here at Nadex. We will have a look at that also in much more detail in the live part of today's webinar. Today's webinar is brought to you both by Trade with Position and by Nadex, so I would like to start with a very brief introduction of those two companies. Trade with Position has been started or has been founded, created by Nick McDonald in 2006, and we provide education for retail traders. We provide international trader training for clients of global brands, including exchanges and brokers worldwide. Our cooperation with Nadex started back in 2011, and we're a company run by traders for traders. Sorry if this is not the polished presentation and polished webinar that you wanted to hear, and me not being a trained speaking professional, I trade those very same strategies that I teach here every single day in my own account. And for that reason, put your money where your mouth is a common agenda when it comes to trading commentary. 100% true, not only for myself, but for all of my colleagues here at Trade Position as well. We have specialized and we are specialists in trading strategy. We always want to have a structured approach to our trading. Got a hunch, bet a bunch doesn't work with us. We want to see and have a precise set of rules, that we want to trade that set of rules every single day, day in, day out. No guesswork, to be as precise as possible. Nadex is a derivatives exchange subject to regulatory oversight by the CFTC and has been newly formed in 2007. Just like all the big players in the financial markets, especially the futures and options market, Nadex is based in Chicago. Big benefit when comparing Nadex contracts with contracts at the CBOE, for example, or CBOT. All contracts are settled in cash. No physical delivery. You will never have that risk that suddenly that lorry pulls up on your driveway and you're obliged to take a delivery in soybeans, or that you have to take those barrels of oil. It's always cash settled. Huge benefit, just eliminating a lot of the practical issues with trading, or that can come with trading futures and options on futures. Wide range of global markets to trade, and the two unique vehicles to trade those markets are binary options, which we want to focus on today. We want to get a better understanding about what are those binary options actually, and spreads. Personally, I think binary options are a little bit easier to understand and to use, but this is really a photo finish. It's really heads up, and spreads by no means are difficult. It's just I find the concept of those binary options to be a little bit more intuitive to me. But once you've mastered one of those, the other one pretty much comes easily as well to you. So today it's all about binary options. You can easily trade those markets using Nadex contracts when you're sitting, of course, at your normal trading PC, at your Mac. The platform is browser-based, which means it runs pretty much everywhere. But of course, also when you're on the go, you want to access those markets, you want to monitor your positions, initiate new positions, scan for opportunities. You can do all that on the go with your favorite mobile device as well. You have apps in the different app stores available for accessing those markets. And of course, as it's browser-based, nothing prevents you from opening just Firefox or Chrome or any other kind of browser and accessing those markets on your mobile device when you're on the go. Today's agenda, I would like to kick off with a brief introduction to binary options, and then we should really want to see those things in action. We want to see binary options in action on the live trading platform, dissecting the binary contract components, assessing the various strike price scenarios and binary option pricing components. I want to close today's session with a very brief outlook on how you can start trading with Nadex today. And just a quick reminder, if there are any questions at any given point in time, let me know. I'll do my very best to answer those questions. There are no dumb questions, and I hope my answers won't be dumb as well. So what does binary actually mean? It's just, if you think of a lamp, it's just either the light is on or the light is off. Boolean states, on, off, 1, 0. Binary just means one of two mutually exclusive conditions, such as on or off, true or false. Binary obviously plays a huge role in computer science and programming languages and so on. In the end, it all comes down to there's a current flowing, yes or no. So binary, two states. And what does binary now actually mean for trading? Once again, two states. A binary option has just two possible scenarios. Once it's expired, it can only be true or false. So it can be in the money or it can be out of the money. The price of the underlying is either trading above the strike price, and that's the true scenario, or it is not. Remember, the strike price is not part of the true scenario. If you have a closer look at the platform later, you will soon, or you will easily see that it's always a larger than sign. So the strike price has to be larger, market price has to be larger than the strike price, then the scenario is true, and this option is worth something. At expiry, if the price is below, the price of the underlying is below the strike price, that's the false scenario, which means this option will be worth nothing, 0. So we have two states at expiry, worth 0 or worth 100. Nothing in between at expiry. On our way to expiry, we will realize price has the possibility to be within that range, but at expiry, 0 or 100. The good news is we can profit from both a true or false scenario because we can both buy and sell those binary option contracts. A binary option represents a fixed risk and reward contract. More on that in just a moment. It cannot trade below 0 or above 100. So we are always limited to that range. And as we are always limited to that range, now comes the huge benefit. Our maximum risk and our maximum reward are known upfront. They are clearly displayed the very moment we enter that transaction, at the time of placing that trade. I know my risk upfront. There can be no nasty surprises. The number that sits there and tells me that's your maximum loss. Yes, that's my maximum loss. Yes, we do have commissions, but apart from that, it's really that number and that's it. So even if price gaps up or price gaps down or whatever happens, politics are good enough to surprise us every single day. And for sure, I know that the maximum risk displayed is the maximum risk that can impact my account. If you compare that with other trading vehicles, futures, options, stocks, forex, whatever, you always have that risk that the market will just move big time. And yes, you plan for a loss of maybe 100 bucks, but in the end, the market moves so fast, you have a loss of 500. Can't happen here with those Nadex contracts once you position size correctly and pay attention to your maximum risk here. Each binary contract bought and sold represents $1 per point movement in the contract with a possible 100 points. Let's have a look at that. We have here our, let me grab once again my fancy laser pointer here. We have our lowest price of 0 and we have our highest price of 100. And the price until expiry is always within that range. And this is regardless of what happens in the underlying market, which means if the price goes above the strike price into infinity, doesn't matter, the highest price is 100. If the price drops multiple factors below the strike price, doesn't matter, that option, lowest price it can go is 0. We are always within that range. Now, as we are always in that range, it makes sense to pay attention to when we want to buy or sell those contracts. For example, let's just assume we have one contract here and we think, that market might be going lower. Then the natural thing to do would be to say, I want to sell an option because I think price will be below the strike, or the underlying market price will be below the strike price. And for that reason, once that contract expires, it should be worth 0 if it stays below the strike price. And I can book in the money for which I just sold that contract. And you just pick arbitrarily one contract, and we just pick this one here now. And we can sell this contract now for 25 bucks per contract. Now, does this make sense? Is this a good trade? I haven't looked at the chart. Just from a reward to risk perspective, I don't think that this might be a good trade, because how much can I profit from selling this contract here at a price of 25? Well, I sold for 25, and I think if everything works out, I should be able to settle this contract for 0, so I can keep those $25 which I just got. So that's my maximum reward, 25. On the other hand, if my assessment of the market was completely wrong, prices shoot higher and this contract settles finally for those 100 bucks, what is my maximum risk? My maximum risk is $75 per contract. And now this is a very bad reward to risk ratio. I always want to pay attention to my reward to risk ratio. Personally, it doesn't make sense for me here to risk $1 for the potential opportunity to maybe make 33 cents if everything goes according to plan. If this is potentially a profitable trade, that's just not worth it. Let's compare it with this scenario here. I just picked another contract and I'm able to sell this contract here for 75. What's my maximum profit? Well, if everything goes according to plan, that contract should be worth in the end 0. So I will be able to keep those 75 bucks, which I just got for selling this contract. If I'm not right in my assessment, well, price will go higher and it will settle ultimately probably for $100. Maximum risk is just $25. So here I do have a reward to risk ratio of 3:1, which is much, much better than the 0.33:1 from the example here before. It's important to understand this concept of reward to risk ratio. Now, just going by reward to risk ratio doesn't make sense. We have to look at different things. How likely is it that this contract will drop? It's currently in the money here. How likely is that this contract can drop, or the underlying market can drop from 75 to below 50? Because the strike price should be represented by a value of this contract of around about $50. 50 points. Now, if you go for a contract which has a incredible reward to risk ratio, this usually goes hand in hand with the probability that things won't be working out. An easy, very, very rough and quick idea about what the probabilities might be that you have a positive, or that the contract will end up being in the money, is the price. You can think, those guys of you who have a background in plain vanilla options, you can think of the price of that binary option a little bit like delta. Just like delta can be interpreted as the probability that this contract will be in the money, that's roughly the same thing you can do here with those. It's not precise, it's just a good guesstimate. So if I sell this contract here for 25, I have a bit bad, some would say a stinking reward to risk ratio. But on the other hand, for that bad reward to risk ratio, what I get here is a probability of just around about 25% that this contract will be in the money. So this means that I have a probability of around about 75% that I should be able to make money on this trade. Nothing is sure, it's just the mathematical model underlying those calculations, but that's the potential interpretation and how you can approach that. So going for selling short a contract which is now trading at 98, this is probably so deep in the money that it just doesn't make sense to sell that contract, because the probability is so small, minuscule, that you will be able to make money off that contract, because price would have just to drop so far, so much. Here on the other hand, the probability that you can make money on that trade, much smaller than here, because here the market tells you in around about, very roughly, 75% of all cases, that contract should settle for 100 in the end. You have just 25% going for you. That's just the mathematical model, and it's important to understand that I would never trade just based on those two numbers. I always want to have an edge when it comes to trading, and looking at a chart and reading this chart and getting a better feeling about price action and what I think is likely that might happen next. This is what gives me that edge. And now I here just to have a vehicle to implement that strategy. Buying binaries, same logic applies here. It doesn't make much sense for me to buy a contract which is priced at 75, because I just have 25 more points in value appreciation. On the other hand, if my assessment was wrong, I'm able to lose $75. Maximum reward, just 25, maximum risk, 75. Same bad, stinking reward to risk ratio. Same thing is on the other hand now, if I want to buy at 25, well, if I'm right with my assessment of the potential move in the underlying market, I can have a maximum reward here of 75. I bought for 25, I can settle for 100, should be going my way. I like this much better because I have a 3-to-1 reward to risk ratio. In the end, it comes down to balancing those things. You want to have a decent reward to risk ratio without a probability which is close to playing Powerball. All right, enough theory. Let's have a look at the markets here. And let's have a look at silver. I think silver was rather interesting this morning, and it was really a pity that we weren't able to do that webinar about 2 to 3 hours earlier, because then we would have been right in the center of the action. First thing I noticed when I had to look at the silver chart my morning was price is going lower. We are sitting here once again in this huge trading range, and price is now just going lower and testing this level, which has been had been established quite a long time ago. And just the market adheres to this level again and again and again. And guys, believe it or not, that stupid horizontal line here is a leading indicator, because I knew I was able to draw this line way back in the past, but I knew as price was approaching this line, the market will pay attention to this line. So it slowly dipped below this line, which I thought was rather interesting. This is a weekly chart. Let's have a look now here at a daily chart. All right, we dipped back, and you see already here, we have some kind of retracement going on again. Get a feeling, get an idea of how those different time frames interconnect, how they, what do you think would this candle structure here on the daily chart look like on a lower time frame? And if we drop down to the 15-minute time frame here, and guys, by the way, much more details on how I read the charts in our other live webinars, the market movers and so on. Today it's really done very briefly here just on this price action, because then I want to immediately switch to the platform and illustrate some of those ideas that I had this morning. Price was going lower on this 15-minute chart, and price broke below this level. And the fun thing about those levels is usually, not always, there is never a guarantee when it comes to trading, but usually if price breaks through a level, this level has been acting as support, and you can see it has been acting as support here a little bit. But once support is broken, it turns into resistance. And a common pattern you see all the time, not all the time, but very often, is that if that level is broken, price drops below this level, you will get a bounce back. And a very nice prime target for this bounce back, for that retracement, usually is once again that level. So what was my idea in the morning when I saw that kind of move here? Let me tell you a little bit more about those moving averages here. We look here at a 10 and 20 period moving average. Price is always trying to, you always have this change, that rotation between price being pushy and trying to raise away. And it's just like a little dog. You have that little dog on your leash, and price is so full of energy, it just runs away, and at some point it has to come back to you because it wants to check back. Hey, are you still there? Are you following? What's wrong with you? And this coming back and checking, we're using the 10 and 20 period moving average here to help us to identify those areas where you, the owner, are, and your little dog is just coming back to you. And price is practically doing the same thing. Price moves from time to time very fast, just like we saw here, but we like to call this price is overextended at those levels, because the distance to our moving average sell zone, those price equilibrium levels, is now just too far away. So when price reached those levels, I was about to initiate a counter trend trade. And if you have a look at several things here, this level was a prime target for that pullback. Next thing is, this level at that point in time here was sitting pretty much right in the sweet spot of this moving average sell zone. So next thing to check, if I go for my Fibonacci retracements, I'm just going here, you can see that this level sits right once again at the sweet spot between the 50 and 61.8% retracement. And I think if we go for this retracement here, you can see that this level also clusters with this higher order Fib retracement perfectly with a 38.2% retracement. So I have built now a case that I do have multiple reasons that we can get a pullback here to this level. All of those are leading indicators. I knew this level way back from the past. The very moment I thought, wait a minute, this could be my swing point low here, I was able to draw those Fib retracements. All those were able to give me an idea about what might happen, where price might be going. Now, Making this actionable with, or potentially actionable, I have to be careful here with my wording, guys. Sorry about that. And let's zoom this a little bit more here. And we want to, sorry about this brabbling. All right, here we are. Now, the idea here is, once I saw that pullback, price was sitting at 15.53. What was a potential target for this pullback? I have now made a case that I think that this level of 15.65, something like that, might make sense, might happen. Do I think it's likely that it happens? I think that it's more likely to happen than not. But I never know for sure, which is why I have to be so sure about my risk management. That once again, I never will know if that works out or not. I can only analyze my statistics when I look at 100 trades. Then I should be able to see, worked in 60 or 70% of all cases. And that's more than enough if I pay attention to my reward to risk ratio and keep on doing that same thing over and over and over and over again. So I'm sitting here currently with my price. I think we might see a pullback to 15.65. Which contract would I pick? First thing, I have to make sure that I pick some kind of expiries here. And usually I always want to give those trades a little bit of time to work out. Now, we saw this pullback, and how long do you think it takes? I know this is hindsight now, but how fast can this pullback actually take place? I would give this trade, or I would give that chart here, I would assume give me 3 to 5 more candles, and then we should see that pullback. Here it happened on the second candle already, but 5 candles, each going for 15 minutes. So I want to see something, an expiry cycle that gives me at least 1.5 hours, probably more. The moment I looked at that trade or that contract had about 3 more hours, 3.5 hours life in it. And this was more than enough. And this would have been my contract and expiry cycle there. Again, you have to make up your mind what you want to do. More time, slower reaction in price. Less time, you feel the heat. It's just those prices move and adapt much faster on those shorter expiry cycles. You must give that trade time to work out, give it time to play out. All right, so price was sitting there. I think 15.65 could have made a good target. So one possible approach would have been to go for that contract here. Sorry, I have to make it larger again. Sorry. The idea would have been 15.65. That was the contract. At the time, we were trading here at those levels. That contract was roundabout priced at maybe 14 to 24, 14 to 25, 15 to 25, something like that. Now, the basic idea is if price shoots to the strike price, the price of the underlying market shoots to the strike price, we should see, once again, coming back from those plain vanilla options, thinking about delta, the delta of a plain vanilla call sitting at the money should be very close to 50%, 0.5. And that's the same logic here. If I think I can buy something here now for, let's say, 20, and price keeps on shooting higher and price goes to hit my strike price, I should be able to maybe get something around about 40 to 60 for that trade, for that contract. Does this make sense? Guys, if you do have any questions here, just let me know. The very important takeaway for me here is I can initiate that position easily and I can close that position early. I can manage my position. It's not that I have to wait until that contract finally expires. That would have never been the plan here for me for that play. Price drops below this level. I see we are likely to get a bounce back to test this level now, acting as resistance. And so the idea is I buy something cheap, and I think I know that I maybe should be able to sell it for there's a decent chance that I might be able to sell it for around about 40. If I bought it for 20, that's 100% on that move. Does this make sense? So it's not fire and forget. I want to manage that position. Okay. One very honest feedback, no, it doesn't make sense. That's perfectly fine. Let's have a look at those contracts here. If I think price is now able to come back to test this level, let's just assume, I don't see it on that chart, but that's just my assumption here. I can buy this 1565 contract now for $29. If I buy this contract now for $29, if it's trading here up at this level, we should be able to see a price very close to 50. Where are we trading right now? 50, 1560, 1560. Yeah, you see the volatility in that we're in the money. We should get a price very close to 50. Here, time is already starting to run short, not giving us those perfect numbers right now. Let's have a look maybe at the weekly expiry cycle. We're just sitting in between those numbers here. Sorry that I can't illustrate that principle here in a better way. The idea is, if I can buy this now for a price of 25, let's just buy it here. Once again, it's just for demonstrational purpose. It's not actually a trade I would consider right now. So I bought this contract now for 25. I think price might be shooting higher, hypothetically speaking. I don't have to wait those 53 minutes for that contract to settle. What I can do now is I can just put in a limit order. I can say, all right, I bought it for 25. I'm happy to sell this contract now for, let's say, 35. It's a limit order. I just put it in there. It's sitting here, it's waiting, and once price starts to shoot higher, that order will get triggered once the market is there and once the other market participants put in those orders at the exchange. So I can actively manage that position. I don't have to wait and hope and pray that this market will settle above my strike price of 1565. The idea here is I think I can anticipate this spike higher, and I want to profit and participate in that spike and that spike only. This is how I would have approached trading that market here in the morning. The next thing, this is a counter trend trade, a little bit more risky than the trend following trade. The next trade that you can do is once we get this pullback here into a moving average sell zone, we are at price equilibrium levels, we have good strong action here in our momentum indicators like MACD, like RSI, no divergence setting up at that point, which makes it for me, again, rather likely that we'll at least see a retest of this old level here. So if I think price might be going lower, I might be looking into selling one of those contracts here. But I think that it's likely the price might test after spiking up so far, after this sharp, steep pullback, that we will get another test of those lows here. Yes, I could have then sold a contract which is in the money. For example, selling that contract. I see as it's trading at 77.50 cents, my maximum profit would be those 77.50. My maximum loss would be just 22.50. Same logic applies here. Do I wait and hope that this will settle below this the strike price? Yes, I could do that. Or once again, I could actively manage that trade. Just the same way I did before, I can just put in a limit order and say I want to close that idea, that contract up front. Guys, we're already running short for time, so let me quickly here jump back. Keep in mind, it's not just about those contracts and which strike price to pick. You always want to have an idea about what the market might be doing next. It's not just I pick that contract and that's a sure winner. There are never sure winners in trading. It's important to understand you want to have a strategy. And then those binaries and the spreads are just the means to implement that strategy. You have seen here now that binary options provide you with a fixed risk without a traditional stop loss. You know upfront how much money you can lose on that trade. Let me just briefly bring in that platform once again. If I solve this contract now, you see your maximum loss here, and that's it. If I want to lose more money on that trade, potentially, I have to increase my number. And guys, if you go for a 1% risk exposure on your trade, what do I have to do? Well, if I think that that was the trade, I can now just click those contract numbers up here. Oh, I'm risking more than 1% of my 23,667. So I'm going back to 10. That's less than 1% of my account. Done. This is how easy I can apply my position sizing rules here on the platform. I know my maximum profit. I know my maximum loss. All is there. I can just use it like that. Much, much easier than all the other instruments that I know. You have access here at Nadex to many different markets, worldwide indices, foreign exchange, commodity futures from a single account. You have an easy-to-use trading platform with full direct market access execution. You have minimal capital outlay, contracts under $100. It's easy to get started and apply proper risk management at that, even with a very small account. Perfect to get started. High reward trading with limited downside. Your risk is always capped. This should make you sleep so easily and good at night. I can't stress this enough. If you properly managed the chances to blow out your account or blow up your account should be going towards zero. But guys, again, please apply proper risk management. Very, very important. All right, sorry for being over time. If you think that this might be interesting for you, my real recommendation would be, guys, sign up for a demo account. Those had been limited in the past for a 2-week period. Now they are completely unlimited. Take your time, play around with those, get a feeling for the platform. But once again, don't think that the platform and the contract is everything you need. For my approach to trading, you want to have an edge. You want to understand what you see on those charts and take it from there. You have different ways here on that slide to be in touch with Nadex in kind of any in case of any further questions. Yeah, if there are any questions, I'm happy to answer those. But I think for most of you, Daniel, thank you very much for the feedback. Really appreciate it. That's the end for today's webinar, and I